Joining me now is Cameron Dawson. She is the NewEdge Wealth CIO. Cameron, it's good to have you back. And what do you see panning out here, this giving way to a deeper sell-off?
Well, we think that this rally can continue in the coming days, and it really comes from looking at how short positioning got. We can look at things like the CFTC short positioning and saw that it was as short as it was since back in the COVID meltdown in 2020. So usually when everybody agrees that they're short, everybody agrees that they're bearish, it really sets you up for a market rally in the opposite direction. Now, we think we could get to about 4,100, but that's some pretty formidable resistance. That's the 100-day moving average, which is now downward sloping. And we think that the risk is that we roll over from there because data isn't that bad yet. Usually at major market lows, data gets to the point that it's so bad that it's good. And right now it's kind of middling. It started to deteriorate, but really not so bad that it either warrants you being a contrarian or it warrants the Fed pivoting to step up and support the markets with added liquidity, support the economy. So because of that, we think the risk is that we roll over once we hit that resistance.
All right. So all of that said, I mean, what do you say to people who are, we spoke on Friday with Annetta Markowska at Jefferies about how the second half of the year could see kind of a Goldilocks macro setup. Now she still thinks a recession sometime in 2023. But what do you say to those who wonder if we're going to have a pause here to at least assess the damage? Maybe we've had this nice reset and, you know, it's a period of time where the market can do okay. Growth, for instance, what parts of the market, if any, would you be in right now? Or would you just stay clear of the whole thing?
Yeah, we're still very much invested in the market. We haven't taken down equity exposure in a meaningful way because we are long-term investors and we're sensitive to taxes. So because of that, remaining invested is important, but it's not just broad-based. We're being very focused and focusing just on the quality parts of the market. We're balanced between value and growth and really picking those leaders of quality in each of those different styles. But as we think about the rest of the year, the one good thing to note is that typically seasonality in midterm election years is really rather strong coming out of the midterm election. So if we think over the next couple of months, maybe we're stuck in greater volatility because of Fed continuing to tighten, because inflation remaining elevated, we do wonder once we get towards the end of the year, the better seasonality, if we could stage for a late part of the year rally that could kind of bring the overall returns for the total year higher. But the question is, do we go lower before we get to that point?